After months of negotiations, a breakthrough for some of the world's wealthiest nations. They've finally agreed on how to reduce Russian profits from fossil fuels they import. From Monday, they'll only accept barrels of oil worth less than or equal to $60. It's all in an effort to stop financing Russia's war in Ukraine. The EU will also impose a ban on all Russian oil coming to the bloc by sea.
This price cap has three objectives. First, it strengthens the effect of our sanction. Second, it will further diminish Russia's revenues. And thirdly, at the same time, it will stabilize global energy markets because it allows some Russian seaborne oil to be traded, brokered, transported by EU operators to third countries, as long as it is sold below the cap.
The cap was agreed upon after Poland was assured it would be set at 5% below the market value. Warsaw actually wanted the price to be lower. The US has welcomed the agreement. Treasury Secretary Janet Yellen says it will constrain Putin's finances and limit his revenues. Almost half of Russia's federal budget came from fossil fuel revenues last year. Since the start of the war, it's reported that the Kremlin has made more than $166 billion from oil and gas, and its main customer, the European Union. But with more and more Russian energy heading to India and China, some question if the cap will have any effect.
Well, unfortunately, the price cap of $60 is insufficiently low. We're talking about if the goal here is to actually impose costs and limit the war-making capability of the Putin regime to continue waging its war of aggression on Ukraine, then $60 is insufficient and the price is wrong.
Putin has previously said Moscow will stop sending oil to countries who support the cap. And the Ukrainian president's chief of staff has called for the price to be set at $30 a barrel. But with winter setting in, many in the West see this as a sucker punch to Putin's war machine, while protecting their own interests. Daniel Padwick, TRT World.